Hello, ladies and gentlemen. This is Jesse Colombo, Cyber Trading University's Forex and Futures instructor. I'm excited to announce our closing bell topic today is called How to Turn Next Friday into an Extra Payday with Michael Shulman of Traders Reserve. And Michael Shulman is a trader, financial analyst, and options expert with over 30 years of experience. So he's going to be teaching low-risk, high-reward trading strategies to generate consistent income via options every week, every month. He uses, I believe, weekly options and other types of income strategies with options. So definitely going to be interesting. I'm sure we'll all learn a lot, and I'll be watching myself. And that starts at 4:30. Until then, I'm going to be doing my daily Forex and Futures update right now. Here we are. So started with the S&P 500. You can see it dropped a bit today, just not too surprising after a fairly sharp rally this month, or at least last month, February. Let's start to draw some lines here. So right now, this uptrend is still intact, even though we had a pullback today. And the reason why is because it's still above its high of late December, early January. So that's a major line in the sand that I've been watching, and that represents an important support level. So I always look at prior highs as being important support levels when the market is above it. I was also watching a possible uptrend line. If you're very conservative and you connected these lows that I'm showing, technically it did break, but at the same time, if we were to use the last rally as a model, there were similar situations like that where it didn't turn into a downtrend. So I don't believe that this is I won't call this a true breakdown unless we've seen it break below the late December high. So for now, it's still, in my mind, it's still in an uptrend. It's very possible that we could redraw an uptrend line like this. So for me, the more important support to be watching is that horizontal line that I just drew over here. Also, if you look, could be a little bit of a consolidation now over the past week or so, and that actually is healthy action. You want to see pullbacks, especially if you're not in. That gives you an option. It gives you the opportunity to get in a second time, so it's a secondary entry point. So I want to see if it's going to form a range for a few more days, bounce around, and then maybe launch for another high, and that could be an opportunity to go long again. So I think this is healthy action just from a technical standpoint, but we'll keep on watching. Let's look at the Dow. Even though these indices, meaning the Dow versus the S&P 500, make similar moves, I do like to look at them still at the same time, both of them, and multiple indices just for confirmation, and also because there are different key levels that each index has. So, for example, you'll see a number like 18,000 in the Dow, and chances are that's some sort of a significant number in the Dow. And even though it may not be an important number around that time in the S&P 500, it's still helpful because you can see, let's say if it were to pull back to 18,000, you could also see the S&P 500 make a similar move. So that's why I just look at multiple indices just for confirmation. I don't really put a lot of emphasis on this uptrend line. I don't really trust it too much just because we saw similar action last time where it crossed below but didn't fall. So this horizontal line, which is the late December highs, just like the S&P 500, that's the most important level for me. And it looks like it's consolidating here too, just like the S&P 500 is. So it looks like 18,100 is the support in the Dow right now to watch. It's the NASDAQ 100. You can see it broke out of that wedge that I showed. Still in a confirmed uptrend. just like the other indices. So just keep on watching this. Looks like maybe just like the other indices, probably bounce around here for a little bit, and then we'll see if there's either a breakout or breakdown. Let's look at the Nikkei. Where is it? Japan's Nikkei stock index. Here we go. A little more of a pullback. Still in a confirmed uptrend. Most of these markets move very similarly, but I did say that this was likely to happen actually in the Nikkei. I think I said that on Thursday or one of those days. It was likely to touch the top of this channel and pull back, and that's exactly what's happening right now. And now I'm watching to see if it's going to pull to the bottom of this channel and then maybe rebound from there. So just watch that scenario. If you're looking for a secondary entry point, just watch for it to pull back to this level and then see if there's some sort of a bounce, and then we could see a rally to higher highs. All right, let's take a look. What else we have here? All right, let's take a look at the U.S. dollar index. So we're still in that consolidation range that I've been watching. Really nothing has changed. It's kind of grueling at this point just due to sheer boredom, really just kind of sitting on our hands until there's a major signal on daily before we know that there's going to be the next trend in not just the U.S. dollar index or U.S. dollar, but also all the Forex markets or most of the major pairs, particularly the ones that are paired with the U.S. dollar. So still watching. You can see it's bouncing around, bouncing around. I don't know which way it's going to break out just yet. But when it does, we're probably going to see a big move. So that's really what I'm waiting for. Nothing to really get excited about just yet. Though I will show you a column that I wrote this past weekend that gives you maybe a little bit more color on this topic. Let me just open it up. Called it Why Global Currencies May Be on the Verge of a Big Move. I wrote it in my Forbes.com column, and I'm going to give you guys that link right now so you can read through and see my more in-depth thoughts. And I also wrote several other columns that I'm going to give you the link to right now, just so you can peruse through if you're interested. I made a Facebook post where I included from my public Facebook page, and I have all 5 of the articles I wrote in the last few days, so you can go through. I have a gold and silver analysis. I have the currency analysis I just showed you. I have an crude oil analysis, an analysis on copper, as well as the stock analysis. So maybe you guys will find that pretty interesting. But looking on this chart, I know different charting services, sometimes the charts look a little bit different depending on the data source. But for this particular chart that I'm looking at for the U.S. dollar index, it really looks like there's a pennant pattern. You see this triangle right over here in the U.S. dollar index? And on Thursday, it looked like the U.S. dollar was about to, or was pushing above that pennant. And if that is a genuine pennant, there's a very good chance that it's a continuation pattern where, assuming there's a follow-through, because now that's what I'm waiting for. It's not enough to just push its head above there. I want to see it really have a solid close above there. But if it does, there's a very good chance of a continuation rally, similar to like what we saw back in December and January. So I'm just waiting for the confirmation of that. But I showed in this column that if that were to happen, this downside or potentially downside pennant in the euro would also follow through. I'm still waiting for that. I showed the yen, how it's trading in this wedge. But you can look through on your own. I'll show you the updated charts just in case there's been some action over the last day or two since I wrote those columns. Let's take a look at the dollar yen. Here we are. It's still within that triangle, just bouncing around. It's really, that's all I expect until there's some sort of a confirmed breakout or breakdown above or below these major lines. And when it does, that's where we're going to see some interesting action. And if you are a stock market bull, just even as a tactical trader and you're trading, you're interested in going long, you're going to want to see the dollar-yen break to the upside, meaning you're going to want to see the U.S. dollar strengthen and the yen weaken on a relative basis, because in recent years, in the past 2 years, that's tended to be a bullish signal, especially for the Nikkei, Japan's Nikkei stock index. If you trade EWJ or Nikkei futures, weak yen is bullish in that case because it boosts exporters. And also many market participants see it as a sign that Japan's Abenomics program is working properly. Let's look at the pound US dollar. Here we are. You can see this is on weekly. It just broke above that downtrend. Let's go look back to daily. So it struggled at that 1.55 resistance level that I've been showing for quite some time. And I identified that as a potential resistance level before it happened, before it bumped its head, because it was 1.55. It's a major round number. And also because that marked the lows here in late December. So sure enough, it bumped its head there. Now it's selling off a bit. So now I want to see if it's going to correct maybe back down to the lows at 1.5. I'm not seeing a real bullish signal here at all. I'm not seeing a very bearish signal either. If it can push back above 1.55, it's off to the races, and then I would definitely feel more confident from a bullish perspective. But right now, I'm not seeing a real signal, and I don't expect to see a real signal in any of these Forex markets, or at least many of these Forex markets, until the U.S. dollar index experiences some sort of a confirmation, breakout or breakdown from that pennant pattern. So right now, I expect slop and chop really until we get a real solid move. So for you swing traders in Forex, it's going to be a little boring until that happens. Intraday, there's always going to be moves even in the consolidation, as you see currencies or other markets bounce around, but the best moves are always going to be when the daily time frame, when it's trending. So it creates better moves even on intraday. So that's what I wait for as a trader. You can see this is the Canadian dollar. It's got this narrowing. Well, this is let me clarify, U.S. dollar, Canadian dollar pair. You can see bouncing around. It's waiting for a catalyst. Definitely a U.S. dollar index breakout or breakdown would be one catalyst. Also, for the Canadian dollar, oil is so crucial because it's Canada's economy, and therefore their currency is highly correlated with the price of oil. And that brings up my oil column I wrote on Saturday on Forbes. Where is oil heading from here? I'll include the link. It was in that Facebook link I just put, but just for your sake, if you want to see it right now while I discuss it. So I showed how oil's still in a trading range. It's just bouncing around back and forth. This is West Texas Intermediate crude oil, bouncing in a $10 range between $45 and $55. And I don't expect a real directional move confirmation until there's a breakout above 55 or a breakdown. So this is of importance to Canadian dollar traders. And this is Brent crude oil, trading in a similar range between $65 and $50 per barrel. And I showed how I'm watching the $40 level in both West Texas crude and Brent crude. $40 as the key number, because this goes all the way back to 1990. Right here. I was a tyke back then. Let's put it that way. That's how significant it is. That was the first Gulf War oil panic. Back in the day, early days of Saddam Hussein, when we all first learned who he was. Okay? And that's when oil spiked up to 40, bumped its head right there and fell back. And then during the global financial crisis in early 2009, that is precisely where West Texas Intermediate crude oil stopped. Well, it overshot a little bit, but really that's where it closed and then finally rallied off there. So the fact that we had this major sell-off over the last 7-8 months, And I would expect, as I wrote, it would be surprising if we didn't touch 40. Look, if I was interested in being an investor in oil or going long or playing a rebound, I would personally feel a lot more confident knowing that we already hit 40. And the fact that we didn't hit 40, it makes me not, I don't believe in the bottom. I have a hard time getting gung-ho and saying, yeah, rah, 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 this is the bottom, when $40 is only just a few dollars underneath where we are. So I think there's a good chance there's going to be some sort of a capitulation or liquidation sell-off as the final long traders liquidate their remaining positions, and then and only then we'll see a bottom. And I'm not predicting this because I can't make guarantees about things of this nature, short-term market movements. I've learned not to do that. But I'm just using deductive reasoning, and that's my logic. And here's another reason why I feel that way. I'm showing you this is another chart of West Texas Intermediate crude oil. And if you look at the bottom, this is based on the Commitment of Traders report right here. It shows the positioning of different traders in the market. You can see the red line are the large traders. They're large trend-following funds like CTAs, Commodity Trading Advisor type of funds. And you can see this is what I call the dumb money, because they tend to be wrong at the major market turning points. And you can see they were the most long. They were the most bullish. They had almost 500,000 net futures contracts right at the peak. And that was the peak when I warned about it on Forbes, warned 250+ thousand people that oil was going to crash. And that's what happened. That was when these people were the most bullish. So I don't think these people have a very good track record. So you can see they still have a net bullish position of 300,000 futures contracts. So my suspicion is that there's a good chance they're going to liquidate and get maybe down to even as low as 0, or maybe even net short. And then I'll feel more confident that oil's really at a bottom, because then you've had real panic selling. And also, in recent years, or at least in the past half decade, there have been times when these large traders have had virtually no net position, like in mid-2010, also for a good portion of 2009 right over here. If you can see the left part of the chart, I don't know if you can see my cursor right now on this, but so it's not like it's unprecedented for them to have no position. They're still relatively bullish by historic standards to have almost 300,000 net contracts of oil. So there's a good chance of some sort of a washout where they panic and say, enough, oil's not going anywhere. And then the smart money will come in and start buying the contracts from them, and hopefully me along with the smart money. And then I'll be interested in that trade thesis. But for now, no thanks. I mean, I could be wrong. If I'm wrong, I reverse my position, that's all. But that's just my logic right now as I see it. And that affects Canadian dollar traders. So it's all tied in. These markets are not mutually exclusive. They're all seamlessly integrated. All right, let's take a look. New Zealand dollar. So you can see the New Zealand dollar. It's that wedge I've been showing. Well, I would say secondary support level here, 0.76 I've been showing. And you can see it keeps on bumping its head here. Keeps trying to hit 0.76. Just can't do it. It's a ceiling for now. Maybe it will in the future, depending on if the U.S. dollar index experiences a final breakout or breakdown. But for now, I'm not really seeing it. It doesn't have the strength to do it just yet. But it's also traveling up a channel, so I want to see if it's going to break down from the channel and maybe retest the lows of early February at maybe 0.72. If it can break above 0.76, then I would say the bearish signal that was given back in January when it broke down would be negated. And that was also, I discussed my entire currency thesis in that Forbes column that I posted at 408. All right, so we have the closing bell presenter coming on shortly, but do you have any questions that we can go over really quickly Someone named Lynn is asking me to discuss the British pound Australian dollar. Yeah, we'll take a look at that. Where is it? Oh, okay. Funny enough, last week someone asked me about this too. All right, so just a cursory glance at this chart. It looks like it's following up in a channel. You can see how it bounces, 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 bumps its head, bounces, so on and so forth. That's on weekly. And now let's narrow down to daily. Could be a pennant here. It's definitely some sort of a consolidation I'm seeing right here. You can see it's gone flat, and that also echoes the action that we've been seeing in many other currency pairs and currencies like the Canadian dollar. Just I'm using another charting service so I don't lose my lines, but you can see for the month of February, bouncing up, down, up, down, up, down, up, down. It's trying to fake out the market participants because they have no clue. They have no clue which way it's going until it finally breaks out or breaks down. So it looks like British pound, Australian dollar is doing the same thing. And also be mindful of these overhead. Be mindful of this overhead resistance level, which is the uptrend line. Or sorry, the top of the channel line. And if it, let's say if this currency pair does break down for what appears to be a pennant or triangle type of pattern, the next level I would watch for is the rising uptrend line, which should be a support. So maybe if it drops below here, below 1.96, I wouldn't be surprised to see it sell back to the lower bound of the channel, similar to what it did the last 3 times. I'll show you on weekly again. So just watch the channel. Also overhead is 2 even, 2 British pounds to the Australian dollar. So that's a major round number, and I'm sure that's going to have some significance as well and should definitely be some sort of a resistance level overhead. If it can break above there and then break above this, the top of the channel, that would definitely be a bullish signal. All right, any other last-minute questions before Mr. Shulman comes on in 7 minutes? All right, so should definitely be an interesting presentation. I'm looking forward to it, and Fausto will come on and introduce him in about 6-7 minutes. So enjoy. Take care. Happy trading.
Hello, ladies and gentlemen. This is Fausto from Cyber Trading University. Want to do a quick audio check. Can everyone hear me loud and clear? Just give me a chat back if you can hear me okay. All right, Lynn, thanks you. All right, guys. All right, everybody, we can get started in about a little less than 5 minutes. Everyone just stand by, okay?
Well, if you make me organized, I can make him organized, all right? All right.
All right, ladies and gentlemen, let's get started. Let me do a quick audio check. Can everyone hear me one more time? Just want to do a quick little audio, everybody. Just give me a chat back. Thanks, Donna. Jason, good. Susan, Grant, good to see you. Thanks for coming, guys. All right, well, hopefully everybody's been enjoying the great day we've been having in the market. Even though the Dow's been down 80 points, we're breaking all-time highs, 18,000, my God, and 200. And it's been a very, very exciting new year so far. A lot of good things that have been moving in the market. And one thing, what we always like to do, not only have these events and have all instructors talk about, do a recap at the end of the events, but we also like to run these great events like on Closing Bell. And one thing that we always try to do here in Closing Bell at Cyber Trading University is have great traders and speakers from around the world that we feel that you guys could learn from and educate yourself, because the thing is, great traders never stop learning. And the thing is, great traders want other people to learn how to trade and be good at it too, because we believe that you guys should be doing this stuff on your own. So let me tell you a little bit about Michael Shulman, and one of our new speakers. First time we had him on Closing Bell, so it's definitely going to be a pleasure, and hopefully we're going to have him a lot more often. Let me tell you a little bit about an intro about Michael. Michael, as you know, he's been trading for over 30-year veteran. He's got a background of trading the finance market, also a former trader, financial analyst, financial writer. He's also written 2 books, Selling Short and Made in America. And as you're about to discover, he's also going to talk about how to control and work your portfolio for yourself and take a very unique twist on using it in options. So Mike's going to really kind of cover a little bit about how to invest and do it the right way, and he's going to teach you, also how a lot of traders make big mistakes and how to prevent those. So don't want to take too much time away from Michael. Michael, I want to pass the microphone over to you. The stage is all yours, everybody, and everyone enjoy the presentation.
Thank you, and I want to make sure that everybody is seeing my screen, and someone should interrupt me and tell me if they're not. Show my screen. There we go. And off we go. Thank you for coming, everybody, and here's the typical disclaimer that you see at the beginning of these events. Read it at your own risk. What we really want to get to is if you're an income investor. Income investor or trader, and actually the approach you're going to see, is something for people who are struggling to get consistent income from their portfolio, people who are angry with the zero yields that they're seeing on bonds and on dividends and money funds, and frankly are frustrated by losing money trading options. And people are just simply hungry to put more cash in their account consistently, meaning on a weekly basis, even if you're measuring yourself monthly or quarterly. And of course, if you're hunting for appropriate returns, such as 15 or 20%. In the next 30 minutes or so, and I'm going to move through these pretty rapidly, I'm going to give you a proven strategy. 4 years of doing this you can use to turn every Friday into an extra payday selling options. I've developed a simple, low-risk trading strategy. It can restore your retirement, if that's where you're at, while protecting your capital. Put hundreds to thousands of dollars in cash in your pocket every single week, and end the frustration that I just discussed, and turn your dreams of cash and income, be it reinvested or not, into reality. And as I said, not only is this going to be under 30 minutes, you can do this in less than 30 minutes a week. Those who follow a simple low-risk weekly option strategy are averaging, depending on the size of their portfolio, this is based on our survey data, over $250 a week in total income. And frankly, that's a great extra payday. In February, following my strategy, you could have put $350 per week into your pocket, and I'll show you the details later on. That's over $18,000 a year in additional income, and I assume that you're missing out on that with speculative positions and options. This is not speculative, this is options for income. You might want to know a little bit about me. I was just introduced, so I'll go quickly. I am a 30-year veteran. I've published those 2 books. I'm constantly contributing and writing articles to financial sites such as Seeking Alpha and Microsoft Money, Traders Reserve, and Investor Place. And over the last 4 years, I've helped literally thousands of income-focused investors and traders use the power of options to meet and exceed their income needs. And Since 2010, I've been working with people just such as yourself selling weekly options. You see, 4 years ago, a little bit more than 4 years ago, in terms of my own thinking, I came up with an income problem. My wife and I have twin sons, and they were both about to go off to college. And as you know, college isn't cheap these days, and trust me, the two small, beautiful liberal arts schools they went to were not cheap. I discovered the hard way I had two choices, which was empty my retirement account, deplete its capital, not completely, but take a chunk out of it, which I didn't want to do, and hope to make it up later, or I could create a simple, repeatable system to consistently put cash in my account without any increased capital risk to my portfolio. My target was 1.5 to 1% a week. Every week, mark it up, mark it down, didn't matter. My need for income was not based on the moves in the market. Now, at first glance, you might think that 0.5 to 1%, and 1% is something we see a lot, doesn't sound like much. But remember, that's a weekly income goal. A $50,000 portfolio at the low end, putting in 1.5 to 1% of income a week, is making $250 of cash income every single week of the year. That's $13,000 to $26,000 in annual income. A larger portfolio, you can do the math. 1% a week on a $100,000 portfolio is up to $52,000 per year. And many of my subscribers, we just had face-to-face seminars in Florida a couple of weeks ago, have considerably larger portfolios than that and shared their success with us. If you have a smaller portfolio, you're not excluded from using these kinds of tactics. Even a $10,000 or $20,000 portfolio can use this strategy for one thing and one thing only, and that's to generate cash and income. And if you stick with this training presentation, I'm moving hopefully rapidly, I'll prove to you it's not only possible that my students are already doing it, and they're doing it now. Here are the results of the last 4 years. And we're going to go over today, this week, last week, the week before last. They all pile into these kind of yearly summaries. And every week for the last 4 years since I began teaching this strategy, you can see these kinds of results. In fact, here's an unsolicited quote from one of the students using this approach. This is well worth the money. It's hard to believe how good this is. I started with $200,000 and now it's $300,000. Unsolicited. And I hopefully suspect that you'll have your attention now. That's just one of the students who's grown his own portfolio by $100,000. One of my favorite students in an advanced coaching program just bought himself a house to be near his grandkids in Michigan. And they did this by selling weekly options. Yes, I said selling. Many of you are used to buying. Now, many of you are now saying, no, hold on a moment. Before you run off thinking, oh no, I've lost money with options before, and that's true. Most people who buy options do lose money, more than 80% of the time, actually. But I want you to think about this for a second. If there's an options buyer losing money, who's making the money? The options seller is making the money, and a lot of it, too. Most option traders, even weekly option traders, they do it the wrong way. They're trying to hit a home run trade, right? That 100% or 300% or 800% winner. And how do they think they'll get that home run trade? They buy an option. But here's what the option buyer is really buying. The right to spend capital in the hopes of getting a profit. They're buying risk at the expense of reward. They're buying insanely ferocious time decay, especially with a weekly option. And best of all for us, they're buying options that expire worthless more than 80% of the time. Yes, I just said this, best of all. They're buying options that expire worthless more than 80% of the time. Why is this best of all? Because it means the option seller stands to profit at least 85% of the time. The right way to trade weekly options is to sell them. When you sell an option, you get instant cash. The buyer literally hands you money, so you're now managing profit. Well, the buyer is left to managing risk. When you sell an option, you get the advantage of what I just described, is that insanely ferocious time decay. Weekly options expire, as you might guess, at the end of every week. They may be put on weeks in advance, but if it's a February week 2, they expire at the end of February week 2. In a moment, I'm going to teach you how to capitalize with some specifics on this time decay so that you too can let it work in your favor. And when you sell an option, you get to exploit that 80% or more buyers who see their options expire worthless, which means the odds are in your favor that same 85% of the time. And when an option expires worthless, you, the seller, you keep all the cash that you've collected. And your broker won't even charge commission to close the trade. It's a one-sided trade. So please, my suggestion, my recommendation, with urgency I ask you, stop swinging for the fences in those home run trades. In the next few minutes, I'll teach you my strategy to pay yourself that 0.5 to 1% a week in cash income by selling options every single week. Then you'll be able to start giving yourself the extra paycheck I alluded to every single Friday. And as I said before, over the last 4 weeks in February of this year, my followers took in $500 per week using this strategy. Now, most option traders speculate by buying options. I don't speculate. I accumulate cash, and lots of it. I sell risk in return for cash. There is no more capital risk in selling an option than there is in buying shares. The option buyers buy risk and give me their cash every single week. And as you'll discover, you'll get their cash too. So when you sell an option, what you get is the instant cash, and you get risk transfer, what I keep harping on. When you sell an option, you're transferring risk to the buyer. You're protecting capital. You have this great tactic. You're putting your capital up with no more risk than buying an equity. And you have simplified trade management. When you sell an option, you're managing money you already have made. It's already into your account. And selling options for consistent income is a viable and safe way to put that cash in your pocket, even with a target of 1.5% or more a week. And when you learn this simple, repeatable strategy, you'll be able to enjoy the thrill of giving yourself that extra paycheck every single week. It's how I and my wife put those wonderful twin sons through college. I'm proud to say they graduated this past year. Now they're collecting their own paychecks. So you're probably wondering how hard it is to sell options to generate cash. Let me take a few minutes to show you how easy it is without putting your account at risk. A few key points. In order to sell a put option, you must have the capital on hand as collateral in the unlikely event you will put the shares. In order to sell a call option, you typically must have 100 shares of stock held in your account in the event you're called out. To generate your weekly paycheck, you need at least, we recommend, account size of a minimum of $10,000 in capital. You can do this in an IRA, and the highest premiums and the largest amount of cash produced occur when you sell an option, not when you're using other option strategies. So what are weeklies? Selling weekly options are no different than monthlies, except for their duration. The majority of weekly options exist for just 1 week, expiring at the end of each week. Many highly liquid, well-traded names, weeklies come out 2, 3, 4 weeks in advance, not just the week before, but probably 7 out of 10 weekly options open up the Thursday before the week of expiration. They're available for 6 trading days. And my approach is to sell weekly options during the week they're scheduled to expire. And of course, on the 3rd week of each month, my favorite week of the month, which is options expiration week, it means every option, every monthly, becomes a weekly option. As I said before, more than 80% of all options expire worthless, which means the buyer loses all their money. And the seller, you keep the money you've already collected. And the value that they have bought decays every hour as expiration approaches. Another cash benefit is when you sell an option that expires worthless, you're paying 0 commission on the back end of the trade. It's just expiring. It's a very powerful cash management strategy, especially in smaller accounts. And the bottom line is I believe you should be selling options every single week and racking up the extra cash for these reasons. Instant cash, lower risk, fewer commissions. So let's get started with the brief tutorial. So meet your new friend. Many of you, as an options buyer, this is an old enemy, time decay. As you can see, this is an advantage. When an option is sold on a Tuesday or a Wednesday before expiration, time decay accelerates as the value of the option depreciates even if the stock stays flat. Now, more than 400 stocks are available to you for you to enjoy as the seller. This degradation in value due to time decay in a weekly option. And this is ETFs and indexes as well as stocks. You also have to look for volatility. Many of you are familiar with Greeks, with short-term, the implied volatility and all that parabolic and gamma and delta stuff. And I'm making fun. I'm quite familiar with it, as you might guess. But when you're selling weekly options, you don't worry about that. You look for volatility and you look for volume support, where people are coming in and buying and selling the shares on the 3, the 5, and the 10-day charts. Those will provide you with very short-term support levels, and ceiling levels for a stock. And you're looking for liquidity. You obviously want to look for positions for strikes, the strike price being the date, the expiration date, and the price that you would be put to shares or you would be called out. You're looking for a lot of liquidity. In this example for General Motors, you can see there's an outsized number of contracts at the $35 strike price. So this is the kind of liquidity we're looking for, although depending upon the number of contracts traded in a specific week or in a specific day, you could go as low as between 100 and 200 contracts measured by open interest. And you have to look about when you want to put the trade on. Some of my more aggressive and advanced traders will put it on more than a week in advance to enjoy extra premium and generate extra cash. I typically like to sell in the middle of the week, either late Tuesday afternoon or sometime before midday on Wednesday is when I put out alerts and when I do my own trading, in weekly options. So you also have the luxury when you become advanced in this, you're looking for weeklies that expire that week. Your weeklies for expire any week because there may be an event coming up. There may be an earnings event. There may be a product announcement. There may be an ex-dividend date. You also can treat monthlies that you close early as a weekly. I've had extreme success in, let's say, last week selling a March, and then we have to pay for the commissions, buying it back in less than a week, which was the goal all along. But towards the end of, let's say, the February option cycle, there's extra premium on the March cycle, and you can cash in on this by treating the position as a weekly option. And we also do trades closed in a day. It does not happen often, but sometimes you make so much money, you don't want to put yourself at risk to the gods of the market. You go and you buy the option back. So now you're probably wondering, how does this really work in the real world? Well, first, it all begins with stock selection. During the wonderful wrap-up of the market, you all saw charts. Charts are the last thing I do. It all begins with stock selection, not charts or Greeks or parabolic and hyperbolic this or that. You're looking for great companies, great stocks, options with great premiums. And right now, we're in a stock picker's market. This is the highest deviation of the average stock from the index in more than 25 years, meaning more stocks than any time in a generation are trading independent of the way the indexes move in a given day. We are in a great stock picker's market. And when you get the company right and the stock right, you can trade even more aggressively for profit. So let's get back to the question, how does this really work? Let me show you some trades, and not selected anecdotally to prove a point. We're going to go through one or two trades, then we're just going to go through what we did in February. A recent trade with Skyworks Solution, you can see it's a hot company, but more importantly, it's a real company. This is a very large provider of the circuitry used for the RF features, remote frequency frequencies, in smartphones and tablets. So this is the kind of alert we put out. It was put out about a month ago. Here's a summary of the trade. We recommended getting $65 per contract. It expired worthless, and all the cash was kept in your pocket. This trade lasted 2.5 days. And so for putting up $8,000 in capital, you made $65 in 2.5 days. If you do it 50 times a year, you can do the math. And here's the summary. Yes, it was in a long-term uptrend because of fundamentals. You needed $8,100 in capital. In a $10,000 account, which is the smallest and most difficult size account to manage in this kind of a tactic, you generated $65 in cash. When the option expires worthless, you have a 0.8% return on capital, which is pretty common in 3 days. Now, if you take a look at the way we did this, okay, this was the sequence and the flow of the events. Now, you may be wondering, do you do this on a weekly basis? Of course we do. This is what was closed in February. I'm not omitting anything. These are the positions that were put on and the positions that were taken off. And a couple of these were monthlies that were closed early. And you can see these are all companies often associated with growth, but a couple of them are associated with oil, such as Southwest Airlines, Delta Airlines, and Halliburton. When you're focusing on companies and you're focusing on stocks, this is what you can do. Now, this here was, I did the math, and this is assuming you did 3 contracts a trade, which meant on a low-price stock like Corning, you'd have to put up $7,200 in capital. On a higher-price stock, you might have to put 16, and actually, it's higher than $16,600. If you take a look at Skyworks, you would have had to put up $24,000 in capital to trade 3 contracts. Now let's look at something perhaps more important when you're comparing positions. You have to see, how am I doing? Is this working? Because we do all sorts of training and coaching and independent of the service, and the bottom line or attached to the service is you have to measure how you're doing by annualized rate of return. That means if it's a weekly trade, you multiply your return by 50. Very, very simple math. These are the annualized rates of return that we have for these different trades. You can see that these are well above what you hope to get, but we had a good month, and this is actually quite typical. The average here is a little over 40%. And the bottom line is this is done with very, very simple, straightforward, takes 30 seconds to implement trades. You have an average annual return of 40.75%, or if you want to just take a look at it, on a weekly basis, it's 0.8%, and it's real cash money. Let's walk through some of the logic and how we did this to give you a granular feel how you can do it. Whole Foods Market is the best-in-class national grocer with national coverage in the United States, and it's not here, but its profit margins are 7 times the industry average. It's on a complete rebound. By the way, I own the shares. Based on fundamentals, the stock is moving up due to investor sentiment, not traders, which is very, very important for what you're doing with weekly options. There was short-term volume support where the bulls and the bears argued about the price of the stock in the 55 to 56 range. We put on a simple trade. We sold a $56 put expiring in 2.5 days. We generated $50 a contract. The put expired worthless. It was a target return of 0.89%, and that's 44.6% on an annualized basis. Let me tell you, it's not just the things that are out of the news. It's not just stuff that is not earnings. If there's an opportunity with great companies, you go for it. So I like Tesoro. It was misunderstood. It's a great independent refiner in the Midwest. I followed it for years, and it was thrown out like a baby with the bathwater, and it was time to get back in. In this example, which took a few days, 2-3 days, we did a buy right. I recommended buying the shares and selling the calls, hoping it would be called out. We produced a 1.7% return in absolute dollars in less than a week, an 86% annualized return. And it's a refiner that, as I said, I've been following. Remember, it all starts with stocks, and then it all starts with companies. We go to stocks, and then we go to options. So I want to offer you some stocks to look at right now. I'm going to pause for like 15 seconds if you want to write some names down. It's Apple, obvious reasons. American Airlines, grossly undervalued because the profit savings from US Air are not in there yet. SanDisk bounces around too much. They'll clear up their shortage of inventory in the second quarter. Tesoro, more and more fracked oil, which is lower cost for the rest of this calendar year. Blackstone, best private equity fund and money manager in the world. Gilead, best biopharmaceutical company in the world. General Motors, people were disappointed with sales today. Stock barely budged. People love the company, as do I. I also drive a Chevy. And Grubhub, a high multiple stock, one of the few that I recommend. They have 500,000, 250,000 menus on their site, and they're disintermediating local food delivery services. And I own all of these. Here are those results again. And 93% of the people that we get feedback from when we survey in my service have made that's how they do. They win. They make money. So if this all sounds too good to be true, let's go back to the goals of 0.5 to 1%. That's how this is done. We're going for bunt singles and singles, not home runs. But one student of mine alone, he confirms he makes 98% of his trades have made money. Since I started with your service, I've made 97 trades. 96 have been profitable. This was unsolicited. No home runs, bunt singles, and the occasional double. And that's how successful you can be, and it's why I believe selling weekly options has to be part of every investor's toolbox. Remember, just a 0.5% a week, which is lower than what we did in almost all those trades, is still 25% a year, and obviously you can do better. Now, I have 2 more weekly option trades I want to walk you through, but before I do that, let me show you how you can get started. I really believe it should be in your toolbox, so I've created a complete training program on selling weekly options. This is just the tip of the iceberg to try to convince you that you should spend a little bit of time and learn how to do this. Any investors and traders with any level of experience can start paying themselves regular, consistent income from their portfolios. So today I'm going to do something I've never done before. We've had a lot of success, and I really want to share it. I'm going to teach you the complete selling weekly option strategy. It's a 90-minute online training program. the exact steps, the details you used to put hundreds of dollars of cash, which you just saw, in your pocket every single week. And what it will include is the right way to sell weekly options to generate instant cash, 4 keys to selecting the correct stocks, the right stocks to sell weekly options, a 5-point checklist for picking the best weekly option contract and strike price, and ridiculously simple ways to prevent, which is very important, prevent losing trades. You get a companion strategy guide selling weekly options, a whole bunch of cheat sheets. There are immediate downloads for each component of the trade, all of the training slides, obviously, and a full recording of a live webinar so you can watch it over and over again. And when you complete it, you'll be able to walk away with a complete strategy to start paying yourself that extra paycheck every Friday. You'd probably expect this, and in the past it may have been this, $250, $100, maybe even $49 for this kind of training. It's not today. It's the Selling Weekly Options Training Program is available right now in this show this week for $7.95. And I know it sounds a little confusing, all this for $7.95, but there's no catch. We're not going to give you half a program. There's no 15-day tease, and then you have to pay more for access. It's just $7.95. It's less than the cost of 2 double lattes. Personally, I like the flat whites myself. I'll make this a simple choice. Just think about it. Learn a simple, safe strategy that over 1,000 income-hungry investors just like using every day to put cash in their pocket every single week. And if you're struggling for that consistent income from your portfolio, if the low interest rate environment is wrecking some of the cash part of your portfolio, the part of your portfolio you've designed to generate cash, please learn this simple, powerful option selling strategy. It's going to be the best $7.95 you ever spend to master a very simple strategy that will pay you back. I'm not here, pay you back every week for the rest of your life if you take the training program. And I look forward to teaching you how to put that cash in your pocket. Let's go to 2 more trades. Tesoro, which is now, by the way, around 90. This is what I mean by stock picking, okay, if you look at the details here. Tesoro is an independent refiner that gets more and more of its crude oil from fracking. As I said, I follow it. So back in January, week 2, we sold the $70 puts. The stock was at $71.97, $72.60 when we put out the alert. We collected $45 per contract. It was $7,000 capital required. It closed itself. It expired worthless. And we had the $45 paycheck locked in. 1 commission, a quick $45 in 2.5 days. And remember, this is stock picking. If you had stuck with the stock and followed it on your own, the stock is now 90. Southwest Airlines is another side of the oil price decline. It's a way to, they're an expert manager of their jet fuel. The street knows this. They're having a good business run simply because there's more money for travel. Again, this is what we did. We sent out this alert. It was trading at $41.80. We sold the week 4 $40 puts. We collected $30 a contract. $4,000 in capital required. Stock closed at $45.78. Trade options expired worthless. We kept the $30. If you'd sold 3 contracts, that would have been $12,000 capital. It's $90. You do it 50 times a year, it's $4,500. And just to give you even a little bit more in depth so you see how simple this is to do if you just follow simple instructions. This is typically what I send out. You may have your own crib notes when you're putting together your own trades. But the bottom line, this is all the information you would need either from me or putting together from yourself to go ahead and to make a trade. It was February week 3, the 87.50 puts. We put this out on a Tuesday or a Wednesday. It was a fat, juicy premium, $175 a contract, expired worthless. We had a huge return. And this was put out, there's a typo in here that said 50 times a year. This was put out as a monthly. We turned it into a weekly. And if you go through the previous results, you'll see we had a much higher average return than 24%. The bottom line is we put this example in to show you that we do monthlies, but you can do monthlies on your own, and we turn them into weeklies. And there's the closing alert, and the annualized return was 37%. We closed the trade early and turned it into the equivalent of a weekly. So it's a complete training program. I love doing this. This is a lot more fun than many other things that I do in the course of a day. It's only $7.95. I'm going to get ready to take your questions now, and this is a link that you can go to if you want to. And I urge you all to join in on the program. It's the best $7.95 you're ever gonna spend.
So, Michael, are you with me?
Yes, I am.
All right, I'm watching the questions box for you. We don't have any just as yet, but can you sort of go back to the origin story here for a couple of minutes? And how did you start?
Which story?
The origin story on selling weekly options. How did you start selling weekly options, and why? Again,
oh, what happened was, and I alluded to it very, very quickly. I had saved a lot of money for my son's college education, and my wife had, and it just wasn't enough, and I didn't want, and we always had money in stashes, and the next biggest stash after college was retirement, and we didn't want to tap the retirement fund's capital. So I went into a strategy of selling options, and as soon as I started selling puts and calls, weeklies had just become something you could do. There were only about 50 or 55 when I first discovered them. And it was the same with the service. I traded for a couple of years on my own, selling puts and calls, developed my training, developed my system, and then decided to publish it and share it with everybody. And by then, there were maybe 75 weekly options names, indexes, ETFs, and stocks. And the bottom line was I started doing weeklies. I found them to be significantly more consistent and easier to manage for that specific goal, which was to make a monthly tuition payment. And it was really fascinating because it also turned out that because I sit at my desk and I'm an active portfolio manager, I actually got higher returns than I was getting from my monthlies, and I was getting higher returns from other potential cash-generating strategies because weeklies are only, if it's the middle of the day on Wednesday, you're only in there 2.5 days. You have a really low exposure to market risk and low exposure to company risk. So it turned out to be not only something very consistent, but also very lucrative, and it became a dominant way of my making recommendations or trading my own portfolio.
Great, thank you. And let's see here. Lynn asks, do you write covered call options?
Yes, I do in my own account. I have a bias in my own personal account for writing covered calls. When you're writing a covered call and the strike price is above your cost basis, that the price you would be called out at, I almost, it's like a free money trade. I don't worry about anything. And in fact, we've reintroduced them in Options Inc. Blueprint, which is my service, which is not the training program. Okay, this is not a sales pitch for the service. But in the service, we had enough requests for covered calls. I had stopped doing them after the first year because people weren't making the trades, but we had so much input that people wanted them. The Tesoro trade, the buy right that I suggested, was put on a couple of weeks ago, and we put on another one this week on Monday, recommending a covered call, which was on Skyworks Solutions. And so, yes, I do them, and covered calls are a very important part of leveraging your equities. There's nothing wrong with having a great portfolio of equities, but there's nothing right about them just sitting there while you're waiting for them to appreciate. Everybody should be selling covered calls when they can, weeklies and or monthlies, to generate cash. And your goal should be, if you're using this as an income strategy, to capture 50 to 75% of the underlying stock's appreciation. You can't get 100 of it if you're writing calls, because occasionally you're going to be called out, or you're going to have to roll the calls forward and manage the position where you're giving back a little in the appreciation of the stock. But if you could sell Apple calls. If Apple never moved a nickel for the next 12 months, you could generate a 25% yield, 22 to 25% selling weekly calls. So it's a tremendous income strategy to sell covered calls, and I'm really glad you asked the question.
And Scott has one of your absolute all-time #1 favorite questions when it comes to selling options. You already know what it is. It's your friend. It's mine. Why not use spreads?
Okay, since I don't use spreads, let me say I'm not a spread hater, and I have 2 advanced coaching programs that have evolved out of the membership that we put together, and they wanted coaching. In fact, the seminars in Florida were with a lot of my coaching people. And we do spreads. We do simple ones. We do lead call spreads. The main reason I don't do spreads is to properly manage spreads. you have to take a capital risk. You may be minimizing your capital risk, but you do have to accept capital risk. I can't get into details, but we do something called rolling, where if you sell a $50 put and the stock goes down to $49.50, well, let's say 49, you roll it into the next week. And rolling, we did 85 open and closed trades last year. We had to roll, I think, 13 or 15 positions, and I think 7 were weeklies, and we got out of every single one, every single weekly, with the, I think it was the exception of one which we put on as a high-risk trade before an earnings announcement. And the bottom line was rolling really works, and it's far more profitable than spreads. And the other thing is, I opened this, the half of the sort of little tutorial here was stock selection is critical. Well, I view selling an option as a transaction, but it could be the beginning of a series of transactions that equates to one position. Spreads are completely transaction-oriented, which I understand and I accept, but because I like the company and the stock, I have a high level of confidence and can be more aggressive, and you can make more money by selling a close to the strike put, and know that you can always roll it forward if you need to. So there's nothing wrong with spreads. It doesn't fit the capital preservation part of my system, and there's a transaction focus, and I believe there needs to be more of a position focus because that's the way you make the most income.
And next we have Ian with a question, do you ever use a junk put for protection of the naked short?
There's no such thing as a naked short. You can't short a stock without collateral. I mean, maybe a professional hedge fund person could do it, which they shouldn't do. All the puts that any typical individual investor sells are cash covered, meaning they're cash supported. You have to have cash in your account or margin to be able to do it. So no, I'm going for maximum amount of cash and income profit on the position, and I don't want to dilute that by buying that kind of risk. One of the things that I find when I'm explaining this to people is when I have experienced options traders who are mostly option buyers or spread traders, and I discuss this with them, they're looking at grafting their own tactics that have probably been successful for them onto the whole notion of selling on a weekly basis, and selling on a weekly basis based on a pretty strict diet of cash and income goals. They don't work. You need to change your mindset and get your mind around a different set of tactics, the way you may have first learned option buying tactics. And so this kind of hedging an individual transaction is not the way to make the best amount of income in cash. In fact, it diminishes your potential profits. People ask me all the time, what happens in case there's a market crash? Everybody's nailed if there's a market crash. The only solution for a market crash is just if you hedge your portfolio. But most spread traders align their spreads in one direction or another direction based on their view of the market if you're doing indexes. So no, I don't hedge. If people are good at it, they should do it. But it's really a tactic designed around putting a cage around a transaction. And my tactic, which is called rolling, which is a formal industry term, it's on my broker screen, it says rolling, is far more effective at preserving capital and making money.
And our next question here, Boba Fett is asking the Jedi Master, do you need fundamental knowledge of an underlying to establish a directional bias before you employ this weekly strategy?
Yeah. And Boba Fett, by the way, my son, when he was like 5 years old, went to see the redigitized Star Wars, and when he saw you in the bar, there was a scene that wasn't supposed to be there, and he jumped up in the middle of a 1,000-seat theater and said, that doesn't belong there. So I appreciate your avatar. I like a company, and from liking the company, I actually set economic trends that are a little differently defined than Wall Street. I have one called the New American Kitchen, for example. And from that, I pick the best-in-class stocks, companies, and from that, I pick stocks that have enough volatility and with options that have enough liquidity, volatility, and premium to be able to use it in income strategy. I mean, it's a real funnel. So you have to believe in a stock. You can't work backward from charts. I get emails every day at people, I mean, literally every day. I like this should I do this? And it's often momentum stocks that have gigantic premiums. And my answer is very simple. If you sell a put on this and something bad happens tomorrow, the stock could lose 40% of its value. It's a Momo. It's selling at 100 times earnings. So you don't work backwards from volatility. You don't work backwards from delta. You don't work backwards from moving averages. You work forwards from the quality of the company and the stock itself. What that does, it gives you confidence to be very aggressive in picking your strike price, which maximizes your cash and income because you have a belief in the company and stock, and therefore, if the stock for a period of a few days goes against you, you roll it forward. As I said, we had 85 positions open and closed last year. 2 positions we got what I call stuck in, and we're almost out. It's the same company, it was Crude, and it was before earnings. And we were patient, we've rolled again, we accepted the stock, we sold shares, and we're right now at break even, meaning it's a capital preservation first. But it's because I believed in the company and Wall Street didn't understand what it was doing, and I'm being immodest, I did. And it turns out I was right. And you could be the same thing with a stock you love or a company you love. So you use that as the basis for being very aggressive. You'll make more income that way.
Okay, next up, we've got, looks like 2 more questions. Excuse me. Still recovering from that darn flu. Gail has a question here that I have to modify, and obviously you can't necessarily give opinion or direction, so to speak, advice. But if you owned a stock that's currently down and the calls make up, a percentage of that difference between the original buying price and the current price of the stock, say you're down $3 on the stock, is selling a covered call an effective way to manage yourself out of a losing trade?
Oh, it's what I recommend all the time. You have to be careful because you have to be aware that I'm going to give you examples. Let's say Crude was an example. I'll give you a better one. The Whole Foods trade was an independent trade. 2 years ago, a year and a half ago, I rarely do event trades, but I do about 1 a quarter, and I recommended Whole Foods right before earnings. I thought the earnings were great. Wall Street completely disagreed with me. And the stock, it's a $60 put, went down to the mid-30s over time. We actually are now making money on the position. But the important part is we were generating cash all along the way. And what you have to do, and that was the 1 a year. I have 1 of these a year out of 85 or 90 or 100 positions. And I'm not exaggerating. It's literally 1 a year. And the bottom line to your question is you may have to sell a call with a strike price below your cost basis, but remember you can roll that call forward. If the stock starts to move, you then buy the call back and sell another one at a later date. And that's why weeklies are so cool, because if you're doing this with weeklies, you have lots of choices of moving the strike price up and out. With monthlies, as you might understand, there's fewer strikes to move it. So if the stock goes down 35, then it starts climbing back, and it's now about 56 or 56.50. We just kept selling. You keep selling those calls, and you whittle down your cost basis. If you're a believer, this is all if the company's story hasn't changed. This is because there's a trading event that's anomalous with the future of the company. It's not as if the company, like the deep offshore oil drillers, broke because of the change in world oil prices. They're not going to recover for 2 or 3 years at a fundamental level of the company business. That's different than a trading event where Wall Street misunderstood a company's earnings. So if you still believe in the company and the stock, yeah, sell calls, keep track of your cost basis, and make sure you're ready. If you sell at 38 and the stock moves to 38 or 38 and a quarter or 38.50, you buy it back and you sell the 39 or the 40 a week later, 2 weeks later, a month later, and you creep your way back. And you may argue with yourself, would I have better use of this capital if I took the loss and put the money somewhere else? That's a fair question. But if you use the discipline of always trying to avoid a capital loss, over time that discipline really pays off handsomely in protecting your portfolio. So that is the correct strategy.
John Churchill, I just put the link, and I sent it to everybody, the link in the answer box for you. So that should be a clickable link in the answer box to the how to get to the correct page. And then Glenn has a question here, which I'll actually modify also as it is in regards to the use of the more technical options tools that many people use, whether it's the Greeks, whether it's volatility, et cetera. Can you talk again about what you do use when you're looking at a potential options trade?
Sure, absolutely. And I'll even make a comment about monthlies, but when you're doing weeklies, and I know this sounds simplistic, but please trust me, it's 4 years of doing this, well, 6 actually, 4 years of publishing, 6 years of doing this, and I discovered this almost by accident, and now it works flawlessly. It is, when you're looking at a weekly, you're looking at the 3, the 5, and the 10-day volume support, meaning where volume flows in to the stock. And occasionally I'll go out to a 30-day, well, I'll always look at it, but in terms of making a judgment, it's the 3, the 5, and the 10, and then occasionally I'll go out and look at the 30. I know it doesn't sound very sophisticated. Trust me, it really works. So if, for example, General Motors today was hovering on 37.50, and I haven't looked at the charts, but I'm going to guess that 37.50 over the last 3, 5, and 10 days, a lot of money came into the stock, and traders know it. If you're doing a monthly, then you also have to look at 50 and 200-day moving averages because moving, obviously they work as a great ceiling. If you're selling, you want to sell calls, and you think that there'll be a pause, so you're going to be able to see the call expire worthless right before the 200-day moving average, unless the stock is on a tear, is really cool, or the 50. And it's the same thing when you're selling a put. If you think a stock is going to bounce off the 50 and the 200. The other thing is when you're selling monthlies and not weeklies, there are ranges of implied volatility that I recommend. When I wrote the training program for my service, not this training program, I put it down, but volatility was generally much, much higher than it is now. But it's still pretty valid, which is when you're selling a call, you're really looking at implied volatility in the 25 to 45 or 25 to 50 range. And when you're selling a put, it's about 30 to 55. And above that, it's too difficult to manage in an income strategy. So, but for the weeklies, which is why we're here, you're really looking at simple 3, 5, and 10-day volume support. And to support that this works, at these Florida seminars that I gave, a whole bunch of people who have been with me forever, and we do coaching, we do live webinars a couple of times a week, they know I use Options Express, which is also the technology used by the CBOE in their virtual trading site, and the volume support comes in from the side. It doesn't come up from the bottom, and it's very, very distinct. And several of them have set up dummy accounts at Options Express with $20 in them just so they can use the charts because they find it so useful, and I think you can still do it with the CBOE. So people really, really like this approach when looking at weeklies and quickly realize it's just an excellent quasi-technical tool in identifying it. The other thing is obviously premium. Assuming you can't trade 50 days a week, 50 weeks a year. Many people do. I do, but many people can't. You have to have a target transaction annualized rate of return above what your income goals are. So, we talk in the basic core service. People would hope to get 15 to 25%, but if you can see by the charts I showed you, our average transaction return is around 30 because not everybody's going to trade every week, or not all your capital is going to be used. So you have to take that into account, and then you go out and you scout for premium on a stock and a company you like. So the premiums, have to be there. So it really gets narrowed down pretty quickly. The flip side is with over 400 weekly options, if you pick, I call it a bullpen, and I publish one, if you have a bullpen of core names, I know people who trade 5 stocks. That's all they do, and they just trade weeklies on 5 stocks. Big, fat, juicy premium stocks like Gilead or General Motors, believe it or not, has fat premiums, and SanDisk and Apple. They're all really terrific outfits, terrific companies, and they're big, big premiums. So that comes into play sort of technically as well, but it's quasi-technical. It's not anything nearly as sophisticated as this kind of things that day traders use, for example, when they're buying options.
And again, I just put the link in the answer box for everybody. You can just copy and paste it. That's the simplest way to do it. Otherwise, there are a lot of letters in that link. It should be a clickable link in the answer box. If it's not, just highlight it, copy it, paste it, stick it in your browser. This is unfortunately the only way that we can get that link directly to you through this particular webinar platform. Lynn says, can I use my E-Trade account? Essentially, Michael, there are no limitations on types of accounts.
There are none. Some terrestrial brokers like, I don't know, like Morgan Stanley or something like that doesn't really do online. They may make you fill out some more paperwork to do this, but no. And you can do it in IRA. there's a scary term, naked puts. They're not naked. They're cash supported or margin supported puts, and covered calls are just that. They're covered calls. You have the shares in your account before you sell the call. So this is very, very straightforward, and I do it only in my retirement accounts.
Hang on just a second. All right, John. John, you win the trophy for the most clicks in futility. So I'm going to put my email address in the private box to you there. Just email me, and I'll take care of you after the webinar. So take it that way so that you don't have the frustration of something not working. We apologize for that. Hang on just a second, Michael. Do you have base considerations for choosing the right stock?
Yeah, I go over old ground. I have to like the company, and I have to think that the company is misunderstood or undervalued by Wall Street. I know it sounds silly when we're talking about trading for 2.5 days, but this framework of believing in a company and then a stock allows you to be very aggressive with your positions. That's why we have these kinds of returns. I'm not bragging about stock picking right now. Let me brag a little bit or try to coax you into taking training. I got an email from a new subscriber to my service itself. He took this training, and he said, I've been an options trader. I could call it up and read it, but I don't know which mailbox it's in. He said, how the heck do you do your stock picking? And we had a long interactive dialogue by email because I answer all my emails, and I said, it's because I've watched Gilead since 2004. I followed Tesoro since 2003. I followed Apple since the late 90s. I followed SanDisk since I was in the computer business in 1987. And there are new stocks, Skyworks Solutions, Skechers. These were recommended by subscribers. For me, well, Skyworks, I knew. Skechers, I discovered in Thailand. Let me give you an example to your point. There is actually an intersection between the way boomers and millennials spend money. And I don't think Wall Street understands it yet. And one of the places is food. A second place is travel. And that's a little obvious because that's get blended into the general trend towards better, higher quality, fresher food and travel. People are writing, why aren't all the money that people spending, they're saving from gasoline being spent in retail stores? It's being spent on travel and food. But the third thing is lifestyle clothing. And it turns out boomers and millennials have extremely similar brand taste in lifestyle clothing. And Skechers has been a big hit for us. And so it's fundamental research that I do just by reading. I mean, it's what I do for a living. And looking at trends and trying to go where Wall Street can't go initially because, and I'm not criticizing, well, I like to make fun of them, but they have segments. They have to provide their customers with analytical recommendations the way their customers consume information. Traditional retail, traditional groceries, traditional airlines. And I don't look at things like that. Those are a subset of what I look at. So from there, you find a stock like Skechers, which has 59% growth in Asia because the luxury brands are losing a little bit of steam, and there's a more rising middle class in China and parts of Asia that doesn't want a Ralph Lauren shirt, and I love Ralph Lauren and Ralph Lauren stock, by the way, but Skechers is a sub-American brand of a certain kind of lifestyle, that they're emulating the lifestyle, not the bling. And it's a subtle difference, and you have to read stuff like Luxury Daily to get your arms around it. So it's fundamentals, and then, of course, I have my own, they're not technical screens. I have a 25 stocks in a bullpen, another 65, another 65 that I keep an eye on that are tangent, that they're all sort of in the same potpourri of trends that I have. And I just keep an eye on the companies. And then if something happens with the company, I'll go to the stock within the bullpen stocks that I have. I wouldn't suggest you have 25. I would suggest between 5 and 10. I get alerts on my phone or my computer if something's going on, and I check the stock. And for weeklies, what you want to do is I trade on Wednesdays. In my own portfolio, I trade on the Friday before and Wednesdays. Those are the 2 days I trade. Dry trade for a while, find out what works best for you, and then check out your favorite stocks and your favorite companies that have weeklies on the days that you like to trade, where there's the most premium or there's the acceptable market risk. It's a whole blend of things, but it does start with company and stock. And there's in this approach, in order to be aggressive and sell that $37 put when the stock is at $37.30, to get that kind of premium and get that kind of income, you have to know the company and the stock pretty well.
All right, I think that's all the time we have. We're down to the last minute and 11. Michael, thank you for your time and, as always, your expertise in sharing the strategy. Everything is included in the weekly options package that Michael discussed. There is an opportunity to also add his complete options income blueprint program. You'll see that after you take advantage of the $7.95 training package. So you'll have future opportunities to join Michael in his trading program, which is strictly focused on selling options for income, and generating that 0.5 to 1% per week. So thank you, all of you, for your great questions and for your time this afternoon. And Michael, I'll be seeing you tomorrow night on our next webinar.
Yes, you will. Thank you, everybody, for coming. I really appreciate your attention.
Have a great night, everybody.